I think the best way to frame this is to say that any factor that increases the buyer's perception of risk will have the impact of reducing value in a business. But within that, there are probably four examples that we see particularly frequently. So the first one would be where the business has a particularly lumpy revenue model. So if you have a projects-based business where your revenue in the year is dependent upon 4 contracts being won, for example, then that business is much more risky than one that has much smoother revenue flows in the course of the year. I think the second factor I would draw attention to is customer concentration. If a business has a large percentage of its revenue with one single customer, and by large, I'm talking about probably upwards of 30 or 40%, then that will be perceived by an acquirer as risky, simply because a single decision by that customer will result in a large chunk of revenue disappearing. The third factor I would look at is the extent to which the business remains dependent upon 1 or 2 individuals within the business who may not see themselves being involved for long post-sale. So in that circumstance, it's critical that the shareholders build a senior management team, maybe 3, 4 or 5 people across different disciplines who can absorb the knowledge of the shareholders over time and make sure that when they come to leave the business, that they're not taking 90% of the value of the business in their heads with them. And I think probably the final significant factor I would look at is EBITDA margins, and in particular whether or not those EBITDA margins are constant over time. If you're seeing a gradual decline in EBITDA margin, then that will have a big impact on the value of the business because buyers will perceive that as risky. That's a trend that is likely to continue in the future. There are 1 or 2 other specific examples I can think of that we've seen recently. So for example, if you have material litigation pending against you, that is a big turn-off for obvious reasons. And something we have seen a lot of on the tax side is the existence of some tax optimization schemes which were taken out perhaps a number of years ago, but where HMRC now has a very different view of such schemes. Those can be tricky to deal with in a company sale.